everybody. A little bit of housekeeping before we begin. First of all, this is not legal advice, although Colm and Ian are lawyers with a law firm. This webinar session is just for information purposes only. We take about 1 hour. I do try and finish within an hour, but don't be surprised if we go over 5 or 10 minutes. You are welcome to use the question box to post any comments or questions. I do monitor those. For those who need recording and slides, we will be releasing the recording, and slides is okay, Colm, if we can hand out your slides as well too. Okay.
Yep.
So give us until about Friday is when they do go out. The certificate of attendance will be automatically generated to live attendees only. So if you're listening to a recording of this, you won't get that. Some upcoming AML Great Matters topics. We only have one more this year, and that is on AML internal audits, and that's December 10th. And Tom has done a fantastic job. He's almost booked up solid 2026 topics as well. And I also like to always say, we often speak the same language but have different dictionaries. And Colm, you just said it. You said we refer to it as ongoing monitoring, and that's a perfect example of what I talk about when we say same language but different dictionaries. To me, ongoing monitoring is the what I refer to as like the daily screening against sanctions lists and things like that. You refer to ongoing monitoring as something else. So if we use a terminology, please do not hesitate to ask. That makes us pause and make sure that we are being very clear in the terminology we use as well. So we're going to go ahead and get started. I'm going to turn off my camera. I'm not going to do a big bio or our intro on YouTube, guys. I think most people have, met you before, or you're known. You've been a guest before, and of course you can always look them up on their bios on their website. So I'm going to turn off my cameras and just make sure that I am showing my slides. There we go. All right, so I'm going to just go ahead and let you guys kick off. And again, remember to please post any questions or comments in the question box, and I will keep an eye on those.
Thanks very much, Kimberly, and welcome everyone to this webinar. We'll just introduce ourselves again. So I'm Ian Mason. I'm a partner in Walker's Regulatory and Risk Advisory team on Cayman, and with me is Colm Dawson, who's a partner in the same team. And our focus today is about strengthening your AML framework by monitoring and periodic reviews. Now, when thinking about AML, there is rightly a lot of emphasis on client onboarding and KYC, the kind of the beginning bit, but that is only the beginning of the AML life cycle. And AML regulations and regulators make it clear that once you've onboarded your client, that is not the end of the story, and you have to continue to monitor and keep under review your clients and their transactions. So this webinar is aimed to look at what monitoring might look like in practice. And although this webinar is concerned with Cayman entities that are within the scope of the Cayman money laundering regulations as they're conducting relevant financial business, which we will look at shortly, some of this content may still be relevant to other Cayman entities. So if you are a Cayman entity, even if you're not within the scope of the money laundering regulations, you'll be subject to the Proceeds of Crime Act. So you need to be alert, still need to be alert for red flags and triggers that will be picked up in monitoring, such as suspicious activity and suspicious transactions. But before we dive into the detailed monitoring, I'm just going to place this within the broader context of the AML architecture. And much of this will be familiar to most of you, so I'll move reasonably quickly through this part. So the Proceeds of Crime Act, or POCA as we tend to abbreviate it to, defines the predicate money laundering offences. The AML regulations set out the implementing rules, and the guidance notes contain very helpful guidance on the interpretation and application of the rules, including some sector-specific guidance. And then also complementing Proceeds of Crime Act, there is the Proliferation Finance Prohibition Act and the Terrorism Act. And these sometimes get overlooked, but from our experience, similar Cayman regulators like to see evidence that they've not been forgotten as well when they do inspections. So moving on to the next slide. we've just set out the core money laundering offences in the Proceeds of Crime Act. I think, again, most of you will be familiar with that, so we're not going to look at these in detail, but essentially you have separate offences for concealing, arranging and inquiring, as we abbreviate to. And those, as I've said, Proceeds of Crime Act broadly applies to all Cayman entities, not just regulated entities. On to the next slide.
And just to add as well, Ian, I think for context, these, particularly where we're dealing with British overseas territories, there will be offences that are very similar to these in other jurisdictions, even if it's not just Cayman. So BPI, for instance, where we also practice, would have a similar framework. And ultimately, given that it all comes from the FATF guidance, the importance is that you are aware of what the various themes are that you need to be looking out for.
Yeah, I mean, those core offences are certainly fairly well known in other jurisdictions, and Cayman has mostly replicated the UK legislation.
Correct.
Okay, money laundering. So again, I think you'll be familiar with the typical 3 stages of the money laundering cycle. Placement of dirty funds into the system by placing cash or proceeds. Obviously typical cash, sometimes the kind of wheelbarrow full of money into the bank, but I think most banks are fairly wise to those sorts of things nowadays. Layering, so creating, basically trying to hide the dirty funds by creating complex layers of transactions to conceal the origin of the funds. And then integration, so that's integrating those what were criminal proceeds back into the financial system. And then, as I mentioned, as well as the Proceeds of Crime Act, we have terrorist financing. So that is really aimed at forcing change, ideological, political, or religious purposes. And here the funds can come from a variety of sources. So they might come from legitimate sources, from donors, or they might come from criminal sources. And quite often they could involve smaller amounts. So actually they can be harder to detect for monitoring purposes. So that's something to bear in mind. And then on to the next slide, proliferation financing. So this is different again, and here we are focused on financing to facilitate unlawful arms and weapons dealing. And our experience looking at inspection points raised by CIMA is that firms will focus very much on money laundering, but will sometimes forget about these other areas in terms of terrorist financing or proliferation financing, and those points that we often see CIMA raise on inspection reports.
And also just to add in here as well, if you're dealing US dollars, then the proliferation financing point becomes not a second order issue when it relates to the overseas territories, but there's going to be wider concerns for you if you're doing business with Iran or the Democratic People's Republic of Korea, or North Korea as it's known, because US dollars are essentially not allowed to be used with either of those jurisdictions anyway from a US law perspective.
Absolutely. And then within the broader financial crime suite, we have sanctions. Obviously, this has come into prominence over the past couple of years because of the Russian invasion of Ukraine. And the Cayman sanctions regime is extended by UK statutory instrument to Cayman. And to note that this is a strict liability regime, it's not risk-based. So this subject, sanctions, could be a separate webinar in its own right, but we're not going to go into detail now because that's not the focus of our webinar today.
But just one point to note, actually, because it's extremely topical, is that there is a reporting mechanism that's been introduced by the FRA in the Cayman Islands and the other British overseas territories, which has a deadline probably at the end of this month. I know for sure in Cayman that that's the answer. As Ian said, we're not going to hijack this with financial sanctions, but if you are working in a firm where you've been advising anybody that has been reporting frozen assets, please do reach out to us. We can assist you in making those returns.
Yeah, very good point. It is the end of the month, so if you have that situation, you'll need urgent advice on that.
And other legal service providers are available, but just for completeness, we can assist.
Yeah, so the scope. So as I've said, what we're primarily thinking about here is the money laundering regulations, and these apply to all persons conducting relevant financial business. So what we're talking about here primarily is regulated entities, funds, trusts, banks, fiduciaries, and other vehicles, within that sort of area. So that's what we're primarily talking about. But when we talk about the process of crime act later on, that extends beyond regulated entities.
And then when we talk about the overall obligations of entities and how you set out your framework to arrive at your step-by-step and day-to-day for all aspects of it, the critical aspect in that approach is to ensure that everything is based on risk. And just before the camera opened, Kimberly and I were discussing how this will be driven by the nature, scale, and complexity of your organization, but also the type of customers that you have, the country and geographic risk that you're being exposed to, products, delivery channels, and new products and other innovative services. So traditionally, the practice here in Walkers has been very much built upon assisting funds, clients, and asset management more generally. And that is the purview from which we're coming, or sorry, I am particularly coming. But as we move into other areas and advising different structures such as virtual asset service providers, the risk factors that are involved and the identification of those factors and putting in place mitigants will deviate from each other. And so it would be very nice if there was a one-size-fits-all approach, but unfortunately for people that are in the industry and doing it on a day-to-day basis, that's not the case, because regulatory authorities across the world will expect that you have calibrated your controls, including monitoring and ongoing monitoring, to account for the risk, not just of the customers as they are presenting to you, but also the very type of business that you're doing. So the documentation of the risk-based approach should be documented and kept current. But similarly, senior management, and in an asset management context, that could be the local fund board. But also, if you're in a position where you're a director of an entity or you're the head of compliance for an entity, you could well be ultimately responsible for ensuring that the risk-based approach is appropriately documented for your entity. And then on the next slide, it goes into a little bit more detail around how you design that and policies and procedures and senior management approvals for the activities. And documenting that approach on slide 10 talks about the implementation and monitoring procedures and updates, undertaking risk assessments to keep them current. And critically, the piece in yellow down in the bottom right-hand side, as I'm looking at it, is that the risk-based approach needs to underpin the entire financial crime approach for your organization. And that also includes the monitoring activities that you're engaged in. That's not to say that you need to do a high risk, high touch monitoring exercise for all your customers, but it needs to be a statable case that whatever you're doing on a monitoring side of things, it means that you are managing the risk of the entity being exposed to financial crime, because there are a number of different elements to what good looks like. Part of that is what your central business risk is in terms of your activities on a day-to-day, but also then it boils down to the minutiae of individualized customer relationships or buckets of customers and how you approach that. And getting the risk-based approach right at the start means that you're going to be far more credible in the case of an inspection and ultimately to mitigate against. And sometimes I think as practitioners, we're very laser focused on what the regulatory risk is around the papering, but there's also the actual risk that the entity would be misused for financial crime, which blessedly, given the number of sophisticated practitioners that we doubtlessly have on the call, is on the lower end of things where the entity is actually misused for financial crime. But that could be extremely damaging and potentially entity ending for your organization if you don't get it right, particularly if the entity is actually used to facilitate illicit funds. So that sometimes, and it's important, I think, to note that there is actually a risk that the entity can be used as a criminal vehicle, and I think that we oftentimes focus on what the regulatory risk is 3 years on from an expired passport not being updated on time, which is a paper-based risk, and of course is very important in that you don't want to be subject to regulatory censure. But similarly, the actual risk of the entity being misused for financial crime needs to be front and center when you're actually designing your controls.
Yeah, I mean, a couple of points on that. Sometimes people think a risk-based approach means light touch, And if I'm a small firm or small entity,
Yeah.
I don't kind of risk-based approach just means, well, I'm not a big banker, I'm not a big fund manager, so I don't really have to worry about it. But that's not at all the case. Even if you're a small entity, you'll still be expected to explain the rationale for a risk-based approach.
Yeah.
And document it. And secondly, as Colin said, sometimes, and I look at this from a kind of a law enforcement approach, sometimes firms will say, well, look, okay, maybe I haven't complied with the AML rules, but there's been no money laundering here, so what's the problem? But the right regulator view is the focus is on, as we're talking about, policies and procedures. So if actually there's been financial crime as well, that's an aggravating factor.
Absolutely.
You're going to get a bigger fine or criminal offence. So it's not just it's kind of the fact that you've got policy procedures in place is absolute minimum. If you've got money laundering taking place, actual money laundering taking place, that would be viewed even more severely.
And getting away with it isn't a good enough reason to not do something. The fact that you've gotten away with it, to build on Ian's point, and just for context as well, to the audience, Ian was the head of enforcement in the FCA in the UK, so he is speaking from a position of actual knowledge from behind the table. I've never actually done a stint within a regulator, so it is the gap on my CV, but we are very fortunate to have the different approaches and mindsets that are taken from that. And I think that aggravating factor point is very important to take away. That the fact that you have been lucky enough not to be misused is not a good enough rationale for when you're facing off to a regulator. And then on the documentation of the risk-based approach, there is an expectation that there are risk ratings, if there needs to be overrides, alert closures, provision of aid decisions when not to file an SAR. This will depend on the sophistication and the complexity of the organization that you're involved with. And there might be some of you who work in smaller firms that are looking at some of this terminology and thinking, this is completely abstract and I've never had to come across this. And then any of you that are working, for instance, in retail banks will be extremely familiar, I'm sure, with all of the ideas around job aids and links to policy controls and understanding of risk appetites. But FSPs, financial service providers, must ensure that they comply with their legal obligations, which include maintaining evidence of a monitoring cycle, ongoing sanctions compliance, demonstrating timely sanctions freezes if applicable, and then training, audits and board reporting and timely FRA reporting also come into that mix. And I think the interoperability between sanctions screening and then ongoing monitoring of documentation is also something that's interesting. And the use of terminology, as Kimberly has helpfully pointed out as well, can get a little bit confusing because things can be referred to differently within organizations. And then if you're looking at an international book of business, there may be a number of different regulators who may call certain things different, certain similar things that different names, for want of a better phrase, like the defined term procedures in the Cayman Islands, for instance, in respect of CDD documentation collection. My understanding of the word procedure would have previously been that it meant the document that was used to underpin your collection approach rather than a descriptor of the CDD process. So the terminology and getting up to speed with that, particularly when you are dealing and sitting in positions that are looking at multiple jurisdictions at one time, a consistency of use of terminology and trying really to not aggravate a regulator by using one of their terms in a way in which they don't use it, because with the best will in the world, that is very likely on a human basis to confuse the situations. So making sure that you're mapping out your approach based on the jurisdictions in which you're doing business, whether that's through country-specific annexures or trying to roll out a global set of policies and procedures, which is becoming ever more difficult. I think that's an important note to make.
This is a very good point, because obviously a lot of our clients are global clients. So we quite understand, as far as possible, they want to have global processes and procedures. But again, our experience from advising clients on Cayman inspections is that CMA is looking for, have you specifically considered the Cayman provisions?
Yeah.
So if your procedures are at a very high level and very global, but don't refer specifically to the Cayman legislation, and we see this across the board on AML or training or whatever, that will be a point that you will get picked up on by senior inspections.
And that can be even the case, Ian, I think, when there is gold plating involved, as the term is referred to. So if you're doing business in 4 different jurisdictions and 4 of them have different quirks that require you to do things that are higher than in the other jurisdictions that you're doing business in, even if you are gold plating, if those aren't aligned to the equivalent provisions in each jurisdiction, that's likely to be problematic. And to be very frank, it's probably why we continue to get instructions on financial crime issues on an ongoing basis, because it is very difficult to thread the needle correctly between all of this into the mix, and then making sure that your documents reflect what's actually been done in practice. And then, as we'll move on to, as we move through the slides, actually doing what you said you were going to do as part of that process. So we're certainly not for a second saying that it's rocket science or that it's so complicated that nobody can actually get their head around it. But these structures and edifices, again, dependent on the nature of your organization, can become quite complicated quite quickly. And so the audience for this call, as the subject matter experts, probably need to bear that in mind when they're communicating it to teams, particularly the first line teams that are actually doing the collection, as to why it's so critically important that the steps that are taken at the initial stages of the relationship building are done in a way in which you have prescribed in your documents. Because with the best will in the world, if you use your risk-based approach to arrive at an excellent set of policies and procedures, and then those aren't followed, then that's going to be problematic, because the old data analytics line of rubbish in, rubbish out, if you're not actually following your own documentation from the outset, then you're setting yourself up for failure. So don't want to stray outside the bounds of what this session is on, but it's critical that there is an overarching view of this item on an ongoing basis. And then moving on to slide 12, there is an ideal monitoring operational checklist. So monitoring design, documented scenarios with thresholds, typologies, and data fields. Again, this is what goods looks like for an organization where there's limitless resources and you have limitless amounts of time to actually put to it. But these should be potentially some good prompts that you can consider when you're putting in place your systems and controls. Then event-driven reviews tied to sanctions updates, media alerts, and KYC amendments. Business rules to detect use of third-party payees, dormant account reactivations, round-tripping, and microtransactions linked to high-risk corridors. So some of these items will only be relevant for instance, payment service providers. So I would have worked on one of the reauthorizations for one of the largest payment service providers back when I was working in Ireland, and their risk factors of money being sent to the border between Turkey and Syria are not risk factors that would be similar for my asset manager clients that are based in New York, who have a primarily US-based client base, and monies are being remitted almost exclusively from US banks. So that the range of things that we see and the range of things that we advise on needs always to be linked back to the risks that are associated with the business that you're actually conducting. And then data and tooling. Again, this will be dependent on the nature and scale of the entity. We have gone through SEMA inspections where a sanction screening done on a manual basis against the OFSI list, which is the United Kingdom sanctions list, is fine. Obviously, if you're working in a retail bank, that's not going to pass muster because you're probably doing daily screens. But daily sanctions list ingestion and retro screening, fuzzy matching with tuned thresholds, alerts, suppression rules with justification. Like, there's a lot of nomenclature here that we've included, which is important to know, but necessarily not necessarily applicable to your direct business. And then transaction monitoring rules mapped to product channels, peer grouping, and behavioral baselining, IP device and geolocation, anomaly detection where applicable. Again, payment service providers and fintechs are going to be on the front end of this kind of thing. But as you'll know from being an international audience that are on here, there are certain things that you can access from certain locations that you can't from others. And so putting in place any controls that you can in order to mitigate the risk of your entity being unintentionally exposed to customers based in different places will be important. And then case management, time disposition, SLAs, standardized investigation notes, source of funds and wealth, corroboration steps, MLRO decision logs, SAR and CRF templates. Like, this stuff is basically the entirety of your AML program distilled down into a slide, and the various elements all coming together. Management information and metrics, again, alert volumes, hit rates, false positives, time to close, EDD turnarounds, overdue reviews. Again, this is like the laundry list as to what would an ideal scenario would be if you were doing high transaction volume material with probably a retail bank, to be honest, in terms of the level of detail that's involved here. Periodic quality assurance and testing, and there is a poll that's going to be asked around root cause analysis. So periodic scenario and effectiveness testing, sample testing of closed no SAR cases. And some of this will actually be for the money laundering reporting officers only, but it will be important for all staff to feed into this process.
Okay. Can we take a pause real quick? Because I realized, one of our polling questions, like going back to the periodic review side, is the frequency. What's the standard? Do you mind? I am showing that I got disconnected there for a second. Can you still hear me?
Just for a second. Yeah, I can hear you, Kimberly.
Okay, yeah. But if Tom doesn't mind actually launching a quick poll, and while on that first poll on the frequency, because I get asked this a lot. What's the kind of what's everybody else doing? Because I work with a lot of different AML regulated entities and help them with their compliance. And so I am asked frequently. Of course, I work mostly with trust and corporate service providers. You guys, you said you work with a lot of assets and wealth managers and funds.
Yeah.
Is that correct? Yeah, and retail banks. And would you say that it's so here you said what's the standard refresh period for medium risk clients, and you've given the option 1, 2, or 3 years. Would you say that can be different across industries?
Yeah, I think it definitely can be different across industries, because it will depend on what you have defined as your risk parameters for the business that you're conducting. And obviously 1 year tends to be on, and an annual refresh tends to be on the upper end of it, because it's going to be more costly to maintain that customer relationship if you're essentially refreshing on an annual basis. And the 1, 2, or 3, or 1, 3, and 5 tends to be a metric that we see quite a bit in asset management. Usually though, in that context, Kimberly, it's important to note that the board or the asset manager is actually depending on a service provider to do it. So it will actually be the service provider's refresh frequency in the main, but there can be then within that different triggers. So for instance, not-for-profit organizations can be high risk based on FATF typologies, because charities can be used for terrorist financing purposes and for sending funds to organizations that you might not necessarily want to deal with. But if that is an endowment for an educational institution, for instance, and similarly a not-for-profit, that can be perfectly explainable. So you might then decide, actually, they shouldn't be looked at every 2 years. They probably should be looked at every 5 years, because they are equivalent to a state organization, because the only thing they're doing is deploying the capital of an educational institution, essentially for the good of the student body or for the good of the institution as a whole. So there can then be walkbacks from standardized approaches, and that's even within asset management. Not to mention if you were in a much higher risk, or your customer base were in a higher risk jurisdiction that was potentially exposed to corruption or bribery or something like that. I won't say sanctions, because the sanctions risk is slightly different. If you're doing business in an area where there is sanctions risk, you're probably then going to be layering on daily screening, because of the fact that it's a strict liability offence, and all the best risk-based approach in the world won't save you if you actually transact or do business with somebody that's sanctioned. That's just the end of the matter.
Yeah, okay. And here you use the word standard refresh, and I just wanted to kind of clarify, as far as like when you're talking about refresh, some people would say, oh, I'm just refreshing the due diligence, the KYC, the ID, the address verifications. But to me, I think a periodic review is much deeper than just making sure I've got all, KYC on file, for directors, shareholders, it's more of a bigger, let's pause, look at this, see if they went through, have they changed since we onboarded? You mentioned earlier before we started the broadcast about how is my client profile like, was I anticipating that they were going to be doing $500,000 a year, now they're doing $5 million,
Yeah.
And
I think
That's
that's
why.
right, and the word refresh is probably it is the entry level part that people think about. Certainly, is the documents being expired and the passport being expired, etc., or that the corporate structure might have changed. But I think, to my point around the risk of a customer relationship, the quantum of that relative to what you expected would actually potentially mean that it could then be shoved into a 1 year refresh period, Kimberly, because it's so existential to your business. And if you thought it was going to be 50 grand and it's 5 million, then that's a fundamental change to the parameters upon which you took on that customer. It might not actually mean that the financial crime risk itself is higher, but the risk to your business of something going wrong with that relationship certainly would be ratcheted up. So there is the paper-based risk, as I said, in respect of dealing with regulators, the criminal risk of actually being involved in financial crime. But then there's the business risk, which shouldn't be forgotten, because that client relationship could be the reason that you have extra employees employed as well. So making sure that relationship is there. And it could be perfectly explainable that you just ended up having a good relationship with somebody that's become a unicorn and there isn't any additional financial crime risk associated with it. But knowing that that's the case and the explanation for it, rather than it being something that you thought you were doing a personal holdco and now there's 800 personal holdcos being associated with it with no ascertainable means of financing it, that would be an entirely different scenario. Like, that's obviously a very exaggerated scenario, but then also what would play into it is that if you're in a compliance seat and you're dealing with persons who are making money off the back of this relationship, they're going to be extremely reticent, you would have to imagine, to annoy that client in any way, even if you decide as the compliance person that that relationship needs more increased scrutiny because of the potential risk to the business in an overall sense. But allied to that, making sure that that customer file is absolutely vanilla is going to be even more important to you, given its importance to the business on an ongoing basis.
Okay. And just so you know, the people that have responded, 2 years seems to be the majority, with 55%. And then some are saying 3 years is their standard refresh for a medium risk client as well. So we could close that poll. And yeah, so we'll go ahead and we'll do another poll in a couple more slides.
Perfect. So that's moving on to the next slide. Then I think I've flagged that ideal scenario one to death. Governing body and senior management responsibility. This obviously is a very, very significant slide when we're talking in the asset management framework, because the people that we do training for on an ongoing basis, we might do 15 or 20 sessions a year for board directors. It's important to note that senior management are ultimately responsible for this. And even if you are sitting in the compliance seat and you're not on the board of directors, it's critical to know that they are actually ultimately responsible for the financial crime. If the cookie was to crumble and somebody is going to end up facing a penalty, and in a personal sense, that it is going to be the directors that are there. So the approval of the risk assessments and the periodic reports, any audits, and then the monitoring framework, because the policies are going to be set out. The policy is going to set out the ongoing monitoring activity that needs to be undertaken. And so on that basis, senior management responsibility is a very important message to hammer home to anybody that is pushing back on you if you are going through your checklist for ongoing monitoring and people are telling you that this is overkill or et cetera, particularly in the context of outsourced models as well. It's very important to know that notwithstanding any outsourcing, you retain ultimate responsibility. And that's really across the house in terms of regulatory risk as well. So that is the point. Training and staff competence, always an important and topical issue. On the next slide, it talks about the type of training you should receive in respect of ongoing monitoring practices and knowledge of the systems, because your systems and controls are only as good as the staff that are front facing on it. And as I said earlier, the ingestion of information at the outset will actually be key for your ability to monitor the relationship. And if you are, for instance, in a law firm environment and there is a new business intake form, or you have a formal client take-on process that you're looking towards, that being completed successfully will actually probably drive the risk rating of the client, which then will drive the frequency of the review of the relationship. And so it's critical that that is gotten right at the start. So training obviously goes without saying is important.
And again, on training, to reiterate, it becomes a global point. Firms will say, well, we do global training on AML. Isn't that enough? No, it's not. Again, in inspections, CIMA will want to see training on specific CIMA provisions, specific AML provisions and the guidance.
Okay, and so you're saying that the training should include, and this is how you will do a ongoing monitoring, not just the, if they're then high risk, we review them once a year.
It depends on the audience. It depends on the audience, Kimberly. So like if you're dealing with execution staff, then that would be more important. The training parameters for senior managers would really be on the fundamentals of what their responsibilities are primarily. Because obviously, if you've got an executive director of a global bank that has a responsibility for it, they're not going to need to know the in the weeds details as to John Smith is a retail customer, and because of these reasons, he needs to be looked at every 3 years. That isn't really feasible. But for instance, we're doing a big training session for a back office function of a large asset manager. They need to know that information. And even if they're not legally obliged to receive that training, they're the ones that need to have the very targeted information as to the specificity as to what's expected based on the jurisdiction.
Okay, and so our audience should kind of start looking into their own kind of policies and procedures to make sure that the ongoing monitoring or the periodic review procedures are set out as well. And because I've seen that in the past where they'll just say, okay, we're going to periodic review, but they really just talk about the frequency. They don't talk about the actual steps. And the other thing that I've noticed is when you're dealing with a firm, you might have a different type of client. And I'll talk about vessels, when people do ship registrations. To me, that should be a separate review procedure than if you're just providing registered office to a corporate entity. Same thing with like an MPO, that should have a separate procedure as well. Would you agree with that?
In the same way as those type of customer relationships would have a separate CDD checklist. It would make sense that if you're reviewing the customer relationship, then that you would have different indicia, because like I don't do very much in respect of vessels, but I can imagine if the vessel was being used as part of the shadow fleet to move Russian oil, you probably want to know about that. And so any updates to registrations, etc., would need to be known to you in order for you to be comfortable continuing in that space.
Right. Yeah. So it's not just about, making sure that the due diligence, no expired passports. There really is a much deeper aspect to periodic reviews that I think are often undocumented as far as procedures and kind of glossed over in AML policies, and probably rarely staff, as you mentioned, execution staff, that back office staff, probably are not necessarily trained very deeply. And I do think that this is going to be an ongoing, we're going to have to keep improving, so to speak.
I think that's right. And again, it probably goes back to my point around where the risk is lying, because that again is something that you can probably pass muster on a regulatory inspection for if you do have a defined process for timeframes as to when documents are updated. Because when we've been involved in inspections, that does tend to be, you documented that you were doing this on a 135 basis or a 123 basis. You didn't update this customer file on this date. And that is certainly the most easily attainable and documentable finding for or against an FSP on it. But the more in-depth understanding of the nature and intended purpose of the business relationship, which is, I think, probably the point that you're getting to, Kimberly, is certainly something that should be documented and on file. And it's tying those two aspects together and verifying that the relationship that you have continues to be the type of relationship you thought it was going to be, then that is something that is very important from a pure risk perspective for the entity being used for financial crime. So it's definitely hand in glove, the actual risk, the business risk, and then the regulatory risk for not doing what you said you were going to do. But as your very good point is made, perhaps the sections within policy documents need to be built out to cover that a bit more.
Okay, and I have this might be a minor execution question, but I talk about trigger events, and let's take South Africa BVI as an example. And BVI ended up on the gray list. To me, that's a trigger event to go look at all your BVI connected clients, log that as a periodic review. Does that then reset the calendar for when you do your next review, or is that just a trigger event review just in the middle of that 2 or 3 years in your mind?
It would be I think it would be potentially dependent on what your level of sophistication and knowledge of the BVI market was, Kimberly, because that grey listing was expected from a long way out. So if you price that in as part of your classification of the BVI from a risk perspective, then not necessarily that it would be a defined trigger event. Certainly a conservative approach would be, I'm going to go back and look. But I think anybody that had any knowledge of the BVI knew that that was coming. So you could have foreseen that as part of your assessment of the BVI. If there's people on the call sitting in Europe or maybe in Asia, they might view the BVI as high risk at all times anyway. So there might not be an escalation of the risk associated with it because you've already priced in that to your jurisdictional risk. But I don't think there's anything wrong with that being a mid-term refresh exercise as a result of that finding by the FATF. But similarly, I don't think there's too many that downgraded Cayman once it came off the list of countries under increased monitoring as a result of that grey listing. But
Okay.
that would probably be for others to see, because we wouldn't necessarily be discussing why it's a good idea to reduce the risk that you associate with the jurisdiction just because it's off a list. But similarly, does it need to go on to a higher risk footing because it's been on a grey list? Probably. But if it was already high risk, is there actually a trigger event then? Does that make sense? It was a bit of a round the houses way of answering the question, but it would really depend on how you built your framework from a day one perspective. I'm conscious I'm hogging all the time as well. Ian has that important stuff that he needs to get to, so I'm just going to canter through this slide. I love this slide from a monitoring cycle perspective. It is in respect specifically of identification and verification, but it really shows the circular nature of it and the ongoing criticality of the monitoring cycle. So the document information gathered to use to assess and understand the customer relationship, assessing and understanding the customer's business, documenting the assessment and the basis for understanding, monitoring transactions in the context of this customer. That could be monitoring relationship activity in the context of the customer as well. So it's broader than just transactions. Document transaction monitoring or document relationship monitoring is important, because sometimes customers may not be doing transactions on an ongoing basis because they may have just subscribed and their next transaction with you in the funds context will be to redeem. And gathering information from transaction monitoring to further assess the customer if and when that arises. But then that would be that would also be important to note, Kimberly, as part of your deep dive review of the customer relationship as a whole, which is obviously wider than the papering and the transactions that are set out. We have a section included on identification and verification and eKYC, but I'm actually going to skip all of those slides and move to slide 20, if that's all right. You can take as read the electronic KYC component on it. That is a move away from the traditional certification point in the Cayman Islands to achieving certification by other means. We have been advising some clients on how to maximize their efficiencies through use of essentially public information, which arguably is actually a better source of information because you can verify it yourself rather than somebody going into a lawyer and getting a document certified. But that's a separate jurisdictional point. But then on slide 20, we've got the identification of trigger events and change detection. So monitoring and being vigilant of certain triggered events and change detections. Governance triggers, new PEP status, change in directors, UBOs, restructuring or complex layering, change of control, adverse media, regulatory actions. And then behavioral triggers, deviations from expected activity levels or patterns, new or high-risk products, material change in jurisdictions, inconsistent source of funds and wealth information, use of third-party payees without rationale. The use of third-party payees is a great and easy one as to why please explain to us. And it's obviously a source of great frustration for us if somebody is paying our bill and the money comes in from somebody else on behalf of a different fund, because it means we've got a whole lot of administration to do on our side as lawyers. So that kind of thing is a potential red flag, because why would somebody else be paying for advice for another entity? And then sanctions CPF updates to designations, counterparties in or near sanctioned countries, transshipment jurisdictions, trade finance anomalies, and dual use good indicators.
Yeah, and I love this slide because you break it down in that section, and I think this is a great slide for those who are trying to document their periodic reviews, because they can do the same thing. We're going to do a periodic review. These are our triggers, you know, when directors and UBOs change. These are, you know, governance triggers, behavioral triggers. This is what we're looking for. Therefore, these trigger a new periodic review or you know, kind of larger review of the client. Yeah, I like that slide a lot.
Okay, so if we go on to transactional red flags, and in fact, if you look at the Cayman AML guidance notes, they state that ongoing monitoring is not a customer-driven rule, but is rather a transaction-driven rule. So it's absolutely crucial to identify the transactional red flags in your monitoring, and these need to consider all three areas. So yes, money laundering, but also terrorist financing, and as I've suggested, small value transfers or transfers from high-risk regions should be something you're thinking about. And also proliferation financing, so trade anomalies, missing licenses, anomalies in those sort of areas. And of course, you need to calibrate your alerts, because if you're getting lots of false positives, that's not going to be very helpful, particularly when it comes through to thinking about suspicious transaction monitoring. So calibrating alerts is really so that they are meaningful and not just noise is obviously very important in that area. Mm-hmm. And then coming on to suspicious activity reporting.
Quick question, Ian. What about monitoring like dormant or inactive? And I'm assuming I'm talking about banks here, those who monitor payment transactions. What about inactive accounts, or if things if they go dormant? Is that in any? Is that a trigger event right there? If suddenly you realize, oh, we haven't had any transactions out of this a bank account or account in the past 3 months.
Yeah. So if you have a dormant account that suddenly becomes active, then that is something you will be looking at, I think, probably.
Yeah, and there's rules around that. There's actually prescriptive guidance in the context of retail banking as to what you need to do with respect to dormant accounts. And also there's actually the forfeiture to the crown of assets in respect of dormant accounts as well. So if someone goes unexplainably dark, you do tend to need to do stuff with the funds, or you need to manage it. You can't just forget about it, because it ultimately belongs to that person until it then vests in the crown. So any of the overseas territories probably have similar rules.
Yeah, I was thinking more in terms of like if they kind of were inactive for a while and then suddenly ramped up as well, and then to me that would be a red flag.
Absolutely, yeah. Red flag. I think that's nature scale, or that's nature and intended purpose of the relationship as well, Kimberly, because you'd have to triage what it was initially versus what it was after the fact too.
Yeah. Okay.
So coming on to reporting. So if you're monitoring, identify suspicious activity, transaction or a red flag, what should you do? Well, it's fairly straightforward, because if you're a regulated entity, you have internal reporting to your money laundering reporting officer, the MLRO, or your deputy MLRO if the MLRO is away. And it's then the MLRO's decision whether to file a suspicious activity report. So the MLRO will obviously want to get more information, what's triggered the suspicion, look at the facts, the chronology, and get some more information. And then in terms of the external reporting, the MLRO will then decide whether to submit a suspicious activity report to the Cayman Authority, the Financial Reporting Authority. And some of you will know, in fact, we did a webinar on this earlier in the year, that there is a kind of elaboration to the suspicious activity regime introduced in Cayman, where there is a deemed consent regime. So you need to make it clear if you're requesting a defence against money laundering, and if make that clear in your suspicious activity report. And then if the Cayman Authority has 7 working days, for 7 working days at notice period to come back to you or not. And if you don't hear from them within those 7 working days, then consent is assumed. But you need to make it very clear whether or not you are seeking a defence in that situation. And also, we've mentioned the bullet points: declined or terminated business. So you may actually say, well, actually, I don't want this business from this potential client. That's not the end of it. You need to consider then, should you be making a SAR in that situation? Perhaps you should, if you turn down the business, and obviously don't just refer it to somebody else and make it their problem as well. That wouldn't be considered best practice, really.
Okay, let's kick off. We got 2 more polling questions. One was we should have probably done last slide on transaction monitoring. So Tom, if you don't mind issuing that poll, but then you also have after this one. So this one is, does transaction monitoring form part of your approach to ongoing monitoring? And I think it's okay to say no if your industry does not. I mean, I'll again talk about trust companies or company managers, corporate services. So they may not do transaction monitoring. Or do you have any suggestions for how they can do quote unquote transaction monitoring if they don't actually monitor bank accounts?
Yeah, I actually, and this is actually a direct regulator driven experience on CIBA registered persons. So that's a form of manager license that's available, or an advisor license here. So securities advisors don't do any transactions, they give advice. And so any transactions that are done would be executed at the underlying client or underlying fund level. But in order to have an appropriate approach in an inspection, you need to have some form of transaction monitoring. And essentially what it boils down to then is nature and intended purpose of the business relationship, and documenting that in lieu of a transaction monitoring approach. So that was one that I really learned through having gone through a number of inspections and answering the question, there are no transactions at this entity, and being met with, you need to have a transaction monitoring approach. Because I think to Ian's point, he said that the monitoring is actually, from CIMA's purview, is actually driven by transactions. It's not driven by just customer relationship. So it's then important to have some form of review in a documented sense that you're able to produce that would be akin to a transaction monitoring.
Okay, so if I can just repeat that again to make sure I understand. So you're saying even though they don't monitor, they don't have transactions, financial transactions and bank accounts going back and forth, the transaction monitoring is actually about the intended purpose of the business relationship. Could you give an
Correct.
example of what you mean by that? Like, to me, it's like if I was again, I come from a corporate services background. It was like, okay, well, we're going to provide the registered office, for this client. You're saying that's not kind of good enough. Does it need to be more in depth?
It's size and scale as well, Kimberly. So the other points that we've discussed around size and scale of the relationship and the expected nature of that relationship being consistent with what it was at the outset of the relationship. So the points I was making about the quantum of fees and things going up, I would argue that transaction monitoring means transaction monitoring. And so if there's a transaction monitoring section of an inspection log, not the answer of you don't have any transactions should actually be the end of it, but I'm just giving an insight as to what the experience is in terms of regulators. And because it's a section within the guidance, it's important that there is a preparedness to be able to engage on that issue.
Okay, I'd be happy for anybody who has also had a similar experience to put that in the question box, just to share your experience. If you are not a bank or a payment processor, what your experience has been with your regulators during an audit as well. And then so here 86% are saying yes. Again, I don't know what industry specifically. 14% are saying no. So for those of you who are saying no, you might need to kind of document something, even though I realize it's difficult. This is one of those tricky areas that I find for the non-banks, non-financial institutions. If we can end that poll,
that's definitely correct, Kimberly. And there was due to be a secret answer 3 where you're to direct your questions or remarks to to the comments or questions. I think we are running out of time, but
Yeah,
very
yeah.
happy
So we'll go through. Yeah, we'll just go through quickly to the next poll real quick, because you talked about root cause analysis for a SAR, and yes, so do you conduct root cause analysis for suspicious activity identified through monitoring? That threw me. I've never heard of having to do a root cause analysis. Can you explain more about that?
Yeah, it's not a case really of having to do it. It's a do you, as in when something goes wrong in your organization, do you conduct a root cause analysis? So if you think about in a medical context, if they have near misses and surgeries and things, they actually then will review their processes to see what could be improved and to avoid the situation that happened, to avoid potential risk into the future. And so when you go through a SAR process, which can be very intense, and normally lawyers are brought in towards the end of the process to make a determination or to assist the MLRO, or to equip the MLRO with as wide a picture as possible before they actually pull the trigger and say yea or nay, and a filing is going to be made. Particularly in the context of the DAML regime changing here, it's something that has to be considered a lot more. But do you then review the whole entire process and say, was there anything that we could have added into our policies and procedures that could have meant that this SAR never got to my desk because we've updated our procedures to such a robust level that this couldn't have happened? I'm not talking now about somebody popping up on a sanctions list or somebody popping up with a negative news search, which you couldn't possibly have foreseen. It's very easy to say that's your screening, that is your policy and procedure capturing the risk to the business. But if there is a scenario where something could have been done better in your organization, or a policy provision could have been added to avoid this happening, and the cost associated with having to consider these things, do you review the fact patterns and update policies and procedures or approach, or does it form part of it? It's really a discursive effort to try and see if people are actually thinking about it in this context.
Okay,
and
yeah.
It looks like the majority of people are.
Yeah, over 53% are saying yes. And also, I would just add too, when you have these situations, is also, I think, good to update training,
Yeah,
especially if
for
you've
sure.
identified a new trend or just something that kind of came up that has never been addressed in training before. Okay, we can end that poll. And again, we've got about 1 minute left before we hit the top of the hour, so I'll let you guys proceed on.
Yeah, we'll just speed through the final slide. So I'm on the slide potential suspicious activity, and the point I wanted to make here, there are some examples of suspicious activity, these red flags, and a lot of these I think will be familiar to those on the call, and they're sort of things you'll probably be covering in your AML policies and in your training. The point I just wanted to make is you don't have to have actual knowledge to submit a SAR. You just need to have a reasonable suspicion. The case law says kind of strange words, more than fanciable. So you don't have to have actual knowledge, it's just a reasonable suspicion. Coming on to record keeping, this is obviously at the centre of good compliance. You've got to have your records in place. The files, the correspondence, transaction logs, the Cayman rules are for at least 5 years. You need to have those record keeping, the records in place. And on inspections, CIMA will sometimes give you the request, of course, to your documents, and timelines may well be short that CIMA asks those documents, so take that into account if your documents are held off-site or in storage. Turning now to the enforcement side of things, offences and penalties. There are criminal penalties under both the Proceeds of Crime Act and also under the money laundering regulations. There's not just the core of money laundering offences, but also tipping off, something we've not gone into in this webinar, but people will be quite familiar with the kind of tipping off provisions. And there is an administrative fines regime. And this I did just want to dwell on briefly, because there has been an important enforcement case recently from CIMA where they imposed administrative fines totaling 85,000 Cayman dollars, which is I think just over 100,000 US dollars, on a Black Tower Cayman entity. And that's really it's quite an instructive case, because the breaches included failing to scrutinise customer transactions, failing to comply with record keeping requirements, failing to maintain a transaction monitoring system, and failing to perform enhanced due diligence. All the things we've been talking about basically during this webinar, these were very good examples of failings in this enforcement case. And I think hopefully that has given you a good overview of what you should be doing from a practical perspective in this area. We've also included a slide with useful resources and further information, and I think given the time, we're happy to take any questions or comments if there are some.
And thank you very much for your attention. When we were originally looking at this, it did seem that it was the driest of dry topics, but it's when you actually when you peel it back a little bit and you get into it, it actually is central to everything that you're doing from start to finish. So it's a very important consideration for your mix. So thank you very much, everyone, for coming along.
Yeah. Well, thank you very much, and I do appreciate that. We've got 2 more polls, if you don't mind hanging on. One, Tom, if you can release the one as far as about trigger events, and yeah, does your organization have defined trigger events? So here's how I would define a trigger event. Let me know if I'm underutilizing that term. Is whenever a country's risk rating changes, I would then, whether it goes from a low to medium to high or vice versa, that would be a trigger event to review all those clients related to that. Obviously, board controlling board members, UBO changes are trigger events. Obviously, if I was in the banking financial institution, I'm sure here in the States, so I am from the States, we have what's called currency transaction reports, which are if I make a payment over a certain amount, my bank is automatically, sending, stuff to the government there. Anything else that you would recommend as I mean, I know you had a slide that, like, for instance, that they get very secretive or they ask certain questions, for instance, about, like, I'll never forget somebody once asking, is all of this reported back to UK Treasury? To me, that was a red flag. It's like, okay, yeah, we need to look into this particular client.
Yeah,
I couldn't find anything. We didn't file. I mean, I don't recall filing externally or anything, but it was just one of those. The fact that they asked that, but then I thought, well, maybe it was just a genuine curiosity kind of thing. But what other trigger events would you define?
It's very fact dependent, Kimberly, and I think again it's what makes this area interesting, but also hard to be definitive on for a wide group of people that are in many different industries. Because what might be suspicious in one industry, like your point, for instance, of somebody looking for secrecy, is if it's somebody in the US. They're not used to handing out personal information in the same way somebody in the European Union is with respect to driver's licenses and passports and things, because you were essentially in the US. I think historically you could do a drive-through opening of a bank account and you wouldn't have to provide a shred of evidence about yourself, right? That's not the case.
Yeah.
But you know what I mean. Relative to a European structure, where you always had to produce the documents. And I think even the approach on an asset management footing, the approach to representations contractually within a subscription document would have been the US approach previously, as in, I promise you that I'm not doing anything, and this is my contractual bond to you. That was always included in the European documents or in the UK documents, but you also then had to produce identification and verification documentation. So it's that trust but verify point. So, but in the context of trigger events specifically, again, overpayment of life assurance and things is things that just don't make sense. And as Ian said, something short of knowledge, but more than fanciful.
Fanciful.
Fancy? Is it actually fanciful? Anyway, there's a famous House of Lords court case where one of the esteemed justices has a line around what is the trigger for suspicious activity reporting, or when is something suspicious. And so bearing that in mind when you're defining it for your organization is important. It can be hard to fantasize about certain scenarios when you're doing it. But I think that's the most useful from a training perspective.
And whilst we don't want to encourage sort of overly defensive reporting, obviously the downside of making a report is pretty low, whereas the upside of not making a report when you should have made a report is much higher. That's where something to bear in
What's
mind.
that court case, Colm, that you mentioned? The House of
I'll
Lords court.
send on the citation afterwards,
Okay.
Kimberly. I don't want to butcher it.
Okay, that's great. Thank you. So most people here do have defined trigger events, with 82% saying they do. If we could end that poll and do our final one, and which is, what areas do you intend to monitor, I think, in 2026? Because it can change from year to year. And we mentioned, like right now, with the world being the way it is, proliferation financing, the use of dual use goods transactions, things like that, are, I would think, going to be more of a focus. So here we go. We've got expired documentation, expected nature of business divergence from initial instruct. Okay, yep. So there are people looking at that nature of the business relationship. And I'm going to look at my comments. Yeah, so far nobody's put in any comments about what that is. And I apologize, we are going over significantly now, so we will end here soon. I will take a quick look at some of the questions that have been posted that we've not been able to address here during this webinar. And Coleman and Ian, if you don't mind, I'll kind of send you some of the questions I think if you could answer, and then that way we could answer them in any kind of maybe follow-up email as well, if that's okay. All right, so just to kind of save time. So yeah, so most people are just looking at expired documents and that expected nature of business. Anything that you would recommend they also look at in 2026?
With that deal, the use of the year was really just for next year. It wasn't like as if I have any abracadabra moment where I'm saying you must do this for 2026. I think the new products part, because there tends to be a lot of innovation in the area, and then Kimberly, before the discussion, I was saying that we're starting to see a lot of increased asset management activity here on the basis of the proceeds of funds that had been invested in cryptocurrencies. And so whether or not getting into areas where the downstream investments are potentially riskier than investing in a factory in Germany, is that something on the investment side that you want to focus on a bit more around your relationships? But again, it will be, and of course an advisor would say this, it will be very dependent on your business. So I don't want to misspeak and to say that something is mandatory for anybody. It really should be tailored to your business.
And firms may well be using more AI tools now for compliance monitoring, and AI may be coming into this. And obviously AI is work in progress, and of course is changing things and very much improving. But I would just caution against the kind of completely black box approach to monitoring using AI. You've got to be able to explain to the regulator, well, this is a tool, but what is it actually doing? And what are its limits? And what's the oversight? What's the oversight point of view as well?
I absolutely agree with that. We're battling that on our side, trying to make it much more transparent, just even to the everyday user, that is, hey, this is what this particular profile or client is being screened nightly. It's fuzzy screening. You got this matching threshold. We're requiring a country or not a country to be a match, things like that. So bringing out that transparency within the technology is key for us to make that a lot easier, because very good point. Whereas I can remember back in my day, I had no idea. I was just told, yep, everything's being screened. That was it. It was like I didn't, know what settings or anything like that. I just had to rely on, that particular department to let me know if there was a hit, kind of thing, on a screening hit. So yeah, okay. So we are again going over about 10 minutes past the hour. Some practical guidance that I like to give people is start out with managing your client expectations, that updated due diligence will be required. It is not a one-off just at onboarding, that they may have to, let them know in your engagement letters that, there will be ongoing compliance requirements. Make sure you train your relationship managers as well, that they have to explain and that they might need to get an updated passport, or they might have to have a new questionnaire, especially on, account, financial institutions. Train your compliance staff. Make sure they have very specific comprehensive review procedures by the client type. Again, kind of talking about if you're a company manager versus somebody who's looking at like a vessel registration review as well. Do leverage all your reports, obviously, as far as like if your systems have various reports that say, hey, these are the ones that are outstanding, these are the ones that are coming up. I like to prioritize too, especially when you have a whole bunch at the same time. Make sure you're prioritizing your higher risk clients and for their reviews, and monitor your staff leave and absences and turnover. As one staff member leaves, they might have been assigned, they might have been logging these in their calendars. And so you've got to kind of know that that kind of churn or long holidays will impact your periodic reviews being done. And of course, audit them as well. I also make sure that our clients are putting in a procedure that, for instance, if the risk rating has to change, because it's not just
off for us there.
you do have to get that if they go from a medium risk to high risk, that they get that senior management sign off after a periodic review. So it's not just for onboarding. All right. Anything else that you would like to add? Sorry, have I lost you guys? Tom, do you know if we've lost sound?
I think we have lost sound for Carmen.
Okay.
And yep.
All right. Well, I'll tell you what, we will
Frozen.
thank everybody. They are frozen. So Calm, Ian, if you can hear me, thank you very, very much for joining us again. Our upcoming and our last webinar for 2025, I can't believe the year is almost over, is on the AML internal audit. So please do join us. And Tom has been doing a fantastic job. I think you've already got us booked solid pretty much for 2026 for topics. So you'll be able to release that information here soon too, won't you?
Yeah, I've tried. Obviously, AML is constantly changing all the time, so I tried not to plan too far ahead. But we've got pretty much the first half of the year covered with some great guests and great topics. Really looking forward to it.
Yeah, and I'm very excited. We have one guest. I think we're going to get him in March, and he has written a book. He's going to be very different from our usual guests. But he has written a book, How to Launder Money. So I think that's going to be a very interesting one. So I hope you guys do join us. And for those, if you can't join us in December, have a very wonderful Christmas and holiday season and New Year. We'll speak to you again in January, because we're kicking off in January, correct? Tom?
Just waiting to hear back on that one, but
Okay,
definitely something booked in for February.
Okay, fantastic. So thank you again for joining us.